Hello everyone, welcome to a new video. In today's video, we will discuss about should you create an LLC holding company? An LLC holding company is a typical corporate form of small firms and startup operations. This video will be amazing to watch, so watch the entire video. Let's dive into the video. An LLC holding company is a typical corporate form for small firms and startup operations. This form combines the advantages of a partnership and corporation, and it gives tax advantages as well as liability protection for personal assets. Holding companies, LLCs. An LLC can be formed as a holding company, but it will have no operations or functions other than the owner of the firm and its assets. The operational company is the entity where the operations and business takes place, including the workers and obligations. A holding company not only owns the operating business's shares and membership interests, but it also controls its essential assets and effectively lends them to the operating company. In this relationship, the operating company can buy assets and cash from the holding company by taking out a mortgage or security in the asset's interest. What exactly is a holding company? In the past, the parent-subsidiary firm organizational structure was often a parent holding company that held the equity of subsidiary companies. The parent firm and its subsidiaries were all corporations or standard limited liability companies. While it is best to form a new LLC for each new business activity, if the cost of operating a dozen or more businesses is beyond your financial means, the series LLC may be an option. For each distinct firm, some business owners create a DBA. They're frequently ignorant that this exposes all of their firms to the liabilities of one another. Setting up a DBA will not protect your personal assets from the business's creditors. LLC versus holding company. Entrepreneurs will frequently form an LLC as holding company. It often surprises numerous subsidiary LLCs or companies, each of which conducts its own independent business. The holding company holds the subsidiary firm's member interest or stock. The structure is beneficial not just for liability protection but also for tax purposes. In reality, a holding company may be eligible for tax deductions for capital losses incurred by its subsidiaries. A properly structured holding company, on the other hand, does not conduct any business operations. How a holding company is used. Some well-known publicly listed organizations are essentially holding companies with numerous subsidiaries. Instead of being a single corporation with many divisions, the organization is organized as a holding company with multiple subsidiaries. To dispel the myth that holding companies are solely for sophisticated, multinational enterprises, many smaller firms, including many self-employed entrepreneurs, structure as holding companies. Assume an attorney wants to establish a legal service business. The attorney decides to incorporate an LLC for the legal services firm. After a few years of renting office space in a nearby professional building, the attorney decides to relocate to a building he or she recently purchased. Following the purchase of the building, the attorney establishes a second LLC, completely separate from the legal services business, to own the newly purchased building. There are now two legal entities. LLC 2 owns the apartment building, while LLC 1 serves as the holding company for LLC 2. Over the following few years, the attorney will benefit from a consistent income flow from the legal services firm. The attorney then chooses to search for another business to invest in and settles on a fast food restaurant franchise. The attorney sells shares in the holding company and then uses the proceeds to buy the restaurant franchise, which is organized as a third LLC. Benefits of an LLC holding company. The holding company receives several benefits that other firms would not receive if they function as separate entities. In other words, a holding company may own a real estate investing company, a bakery, a financial planning service, and a dance studio. Individually, the four entities would be subsidiaries of the holding company, and the holding would provide benefits by adding value, control, risk management, and taxation. Remember that holding company exists solely to control another business rather than to produce its own services. Value. A member owner of the holding company may have particular skills and know-how that might be utilized to boost the value of other subsidiaries. In the preceding scenario, the financial planning firm has clients that have money and want to maximize their return on investment. The real estate investing company is searching for persons who are willing to give money in order to make acquisitions. As the owner of a holding company, you may connect both parties together by having the financial planning business supply funds to the real estate investing company. Furthermore, the group's combined financial power may be exploited to get more advantageous financing arrangements than if the subsidiaries stood alone. Control. Forming a holding company enables the organization to control more firms with less money. A holding company, for example, might take control of a firm by purchasing 51% of its shares, but in some circumstances, you can take control by purchasing only 25% of another company. As a result, the holding company has become more varied and would not be the largest shareholder, in other words. The fact that a small company owner does not have to own 100% of a corporation allows him or her to manage more firms with fewer investments. A holding company enables the simple sale of a service or product line. The sale could be made by selling the subsidiary without a holding company. Sales may necessitate additional due diligence for a purchase or may reveal trade secrets unrelated to a service or product line. Purchasing power, financing terms, and the ability to invest in larger projects. Risks. A holding company reduces risk. All subsidiaries are shielded from difficulties that arise in other firms. If the bakery is sued because food poisoning caused someone's death and the bakery receives a $500,000 judgment, the bakery and its assets are only worth $250,000. They're unable to attach or collect from the other subsidiaries. Furthermore, the controlling company would not be responsible as long as it did not guarantee the subsidiary's obligations. If a subsidiary takes a risk and fails or declares bankruptcy, the owning company remains unaffected. Tax advantages. The key tax benefit of a holding company is that it does not have to submit separate tax returns for each subsidiary firm. Subsidiaries can generally pay dividends to the holding firm without incurring tax liabilities. Following a receipt of the funds, payments might be directed to the holding company's stockholders or members, or to better investment prospects in the other subsidiaries. If the holding company submits a consolidated tax return, losses in one subsidiary might be offset by earnings in other subsidiaries. As a result, corporations as a whole will pay less in taxes. Furthermore, for tax purposes, 100% owned subsidiaries may be treated as disregarded entities. This means that no additional tax returns are required and LLCs and corporate safeguards can be maintained for business purposes. How much does it cost to start an LLC? There are a number of costs related with their preparation and filing of legal paperwork to incorporate an LLC. In addition, there are additional ancillary charges connected with establishing your LLC with state and municipal authorities. For example, you should ensure that you have all of the necessary permissions, licenses, and certifications required by local, state, and federal agencies. Finally, how much you pay is determined by your willingness to do it yourself. Fees for filing. Typical fees range from $50 to $800, depending on the state. The majority of the entrepreneur's LLC beginning expenditures will be accounted for by filing fees. You don't need a lawyer to submit articles of organization to create an LLC, but it doesn't harm to employ an LLC filing service, especially given the minimal expenses involved. Several service providers may register your LLC for less than $50. Plus, the state charge, the expense of hiring a legal services provider is definitely worth it. It could reduce the risk of filing paperwork incorrectly. Operating contract. An operating agreement is an internal contract that specifies how your LLC will be administered, the owner's members' duties and contributions, and how decisions will be made. Anyone may make their own operating agreement for free. However, when it comes to dividing profits and losses among ownership, you should enlist the help of professionals to ensure that everything is done correctly. Legal service providers can complete the task for $50 to $200, or you can hire a local lawyer. Tax. LLCs, like any other person or entity, must pay taxes. The federal government does not receive a direct share from the LLC. It is instead collected as a pass-through income from the owner's earnings. However, LLCs can deduct some initial expenditures up to $5,000, such as attorney fees, market research, office space, and equipment. Most states tax LLC income in the same way as the federal government does. Profits are deducted from the members' personal tax returns. Some states, however, levy required LLC franchise taxes. In Delaware, for example, the franchise price is $300, but California has an annual franchise tax of at least $800. Why shouldn't a startup be an LLC? LLCs are typically not the way to go for tech or growth companies planning to follow the traditional path of regular and ongoing equity grants to employees, multiple rounds of financing, and reinvestment of as much capital into the business as possible, with the ultimate goal of selling to a big, possibly public company in exchange for cash and/or stock. Listed below are a handful of them. Number 1. Equity compensation in an LLC is complicated. Equity compensation in the form of restricted shares and stock options is one of the most compelling incentives for businesses to offer to employees, advisors, and other service providers. People appear to understand how they work in general. Equity compensation in business taxed as partnerships, on the other hand, is far more complicated, complex, and expensive to create and administer than equity compensation in a C corporation. In an LLC, the equivalent of a stock grant is a profits interest, which, when awarded, frequently requires the LLCs to book up the owner's capital accounts prior to issuing the profits interest. The same issue arises when acquiring LLC interests through options or warrants. Number 2. LLCs do not qualify for the Section 1202 gain exclusion. Section 1202 is one of the most enticing tax breaks for both entrepreneurs and investors. This part of the tax code permits founders and investors to exclude up to $10 million in capital gains from the sale of eligible small business shares, which most startups have. Number 3, LLCs can complicate tax situations for investors. Investors typically do not want to complicate their own tax status by becoming a member of a partnership tax organization, although LLCs are frequently taxed as partnerships. Number 4, many investors are unable to invest in LLCs. Some investors are unable to participate in pass-through enterprises because they have tax-exempt partners who do not wish to earn active trade or business profits due to their tax-exempt status. Many accelerators also demand businesses to register as a C company before being admitted into the program. A holding company enables a small business owner to diversify his activities while avoiding excessive risks. The combination of a holding company and its subsidiaries' resources results in synergies in. I hope you liked the video. Don't forget to like, share, and subscribe to the channel. Thanks for watching.